Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to a very special edition of Charts of the Week. This is the market perspective given the recent incursion and invasion of Ukraine by Russia on February 24th of 2022. Please see our disclaimer for important information. I want to spend a little bit of time here talking about the market events of the moment here. Obviously, we all watched on television last night as Russia invaded Ukraine, something that had been talked about for a while, and there were a lot of very, I think, well-informed and educated geopolitical analysts that actually did not think that this was going to happen, particularly the way that it did, but I think it's still something that it had a pretty visceral, kind of reaction in the market this morning as the pre-market was down about 800 points on the Dow. So, I thought it would be helpful to throw out some slides here and give everyone some perspective on these moments where the market has major upheavals, major down days, and then just looking out that this is always, I always treat investing as a marathon, not a sprint. And so it's easy to get caught up in the near-term volatility elements, because it evokes an emotional response. But the long-term perspective is really important here. So I've got several slides to show you, but I think first and foremost, specifically with regard to Russia and Ukraine, it's helpful to offer a few thoughts here. That basically, since the 2014 Crimean invasion, Russia has been pretty well isolated economically by the West, and even though it is perhaps the largest country in the world by landmass and has a lot of natural resources, minerals, oil, etc. Its economy is actually smaller than Italy's and less than 2% of global GDP, that according to the World Bank. And if you look at, if you combine Russia and Ukraine together, the revenue exposure of S&P 500 companies is only about 1% of total revenue, so not significant. And Russia itself comprises only bit more than 3% of the MSCI Emerging Market Index capitalization. So I think it's important to realize just the scope. This is not China by any stretch. And obviously we'd be having a different conversation if this was China invading Taiwan, but again, that's not what we're talking about here. So, and I think really ultimately, and we'll probably say this a few times today, is the cost of energy is really the primary transmission vehicle by which Russia, by which the invasion is going to impact the Western world. So, Europe obviously is very heavily dependent on Russia gas and oil, and specifically Germany obtains almost a third of its crude oil and about 50% of its natural gas from Russia, and then energy being priced globally in U.S. dollars is going to have kind of a broader impact overall. But I think it's fair to say we're in a period of heightened geopolitical concerns. Market valuations have come down quite a bit, but they are still higher than where they have been. And then obviously we're dealing with inflation, and we're on the eve of a Federal Reserve tightening cycle, which is always inherently a little bit more volatile, as you sit before those, in the weeks, and in this case, a month or two before the actual rate increase. This is always how it's been. So I want to basically kind of offer that as like a starting point that, this is not, volatility itself ahead of a rate tightening cycle is not anything that we didn't expect. But, if you look at, the invasion has led to some downside here. Even though the market's closed up today, the volatility is still pretty high. So we saw risk assets become more volatile. We actually saw a pretty strong bid up in commodities, and then particularly oil. And we did see a little bit of easing in bond yields today as well. So, like I said, the backdrop of this is, markets are a little bit more on edge, I guess, because of maybe valuations still being a little bit higher than normal, and then obviously the Fed, which we've talked about. And I think the invasion, again, if you think about it in terms of energy prices, and everyone knows what they're paying at the pump these days is more than it was, and I think that's really where we may feel the impact of Russia and Ukraine. And I think near-term inflationary pressure on that, on a kind of a more of a specific basket of items, which actually does make the Fed's job of restraining inflation a little bit more challenging. But let's keep in mind that ultimately the Federal Reserve and its actions are the most important thing that we can be focusing on right now. And they haven't really done anything yet other than slow down the pace of its balance sheet expansion. So they're actually still increasing credit, if you will. But we know that volatility is up. Equity indices are now well below their 200-day moving average, which from a technical standpoint, if they find a bottoming out point, it actually would be a pretty interesting place to get involved in the stock markets. But I would just caution that while we're in a period of volatility, that it makes sense to keep some dry powder on the sidelines. We have raised some cash to redeploy when circumstances warrant. But let's see, we've seen that short-term decline in bond yields, which has temporarily improved the performance of pretty straight-on fixed income and particularly high duration. But I think overall, we're still looking at a pretty reasonable year. I think we've got, certainly if you look at earnings, you look at consumer confidence has been shaken a little bit, but consumers have a lot of spending power. They have really strong balance sheets. I do think corporate investment might be restrained just a little bit, but it's still going to grow because we are in an expansion cycle and people are willing to spend even if inflation is higher than it was. So those are kind of a few thoughts right off the bat. I'd say, just based on what I've been reading, the expectations moving forward with regard to Russia and Ukraine are that a wider, broader war involving NATO or the U.S. pretty unlikely. I'd say cyber attacks are probably more likely than any kind of other response by Russia. And then even as I've talked about maybe the near-term impact on energy prices, those prices may be going up, but it could. Ironically, the U.S. is fairly close to a nuclear agreement with Iran that would bring some supplies to the market at a pretty critical time. And then also, you've got winter that's kind of ending in Europe, and so and reports are that it has prepared enough natural gas supply to withstand an immediate shock or some kind of a supply cutoff from Russia. So and obviously from a price standpoint, being higher, I think Russia is certainly incentivized to kind of sit on its hands and reap the benefits of higher prices than it would be to kind of bite its nose to spite its face here. But again, and the last thing I think too is on the European front, looking at the global economic backdrop, the good news here is that I think the rebound from coronavirus and the Omicron variant has been a little bit stronger than expected. We got purchasing managers indices and other economic data that supports this. So I think it's important to, while we're worried and focused on Ukraine right now, not to lose sight of some of these other positive and economic data points right now. So that's that, and so let's get into some of these charts, shall we? So we're looking at various equity indices, and I think it's clear to say that we've had a rough sledding here this year. So both in the month to date and the year to date for all of these indices, down. Now, again, our portfolios are diversified, and we don't look like the index, and we're looking at things other than just straight market exposure. We're trying to be sensible with regard to, some sector exposure, value versus growth, large cap versus small, financial strength versus more speculative non-earning companies, and things like that. So these are just raw index returns right now. And again, there is an emotional response, when you see these negative numbers, and obviously, the unprofitable companies and the high momentum and in many cases technology firms have really taken it on the chin here. So this is something that kind of serves as like a launching point for this broader discussion here. And here we have some data from First Trust, which isolates a big handful of dates where we had major downdrafts in the market, and that's depicted in these blue bars down. I mean, if you look at the far left, you got October 16th of 1987, and I remember that time extremely well. But the takeaway here is that if you scroll from that downdraft day, that one-day return, in that case in 1987, it was over 20% lower on one day. But if you come back, 1 year later, 3 years later, 5 and 10 years later, the market is invariably moving higher. And so, you've got a table of this data over on the right-hand side. And if you look at that 1 year later column, the last time that we even had an occurrence where 1 year later the market was down was back in 2008. And so, but if you scroll over and look at the data on particularly 3, 5, and 10 years, I mean, it's fairly consistent that not necessarily in terms of the magnitude of the increase, but the markets are up. And so when you have a big downdraft day, obviously you generate a lot of volatility at that moment in time. And unfortunately, a lot of people tend to use those moments of panic to sell when that should precisely be the time at which they're considering buying and then holding for the long term. And I've always said that investing is much more of a marathon than it is a sprint. And there are market timers and market traders that can be really good in the short run. It's hard to be really good over long periods of time in trading the market, but usually on big down days, like we have seen some of these down days, again, nothing like 1987, but we've seen some down days here lately that kind of raise some eyebrows. But just suffice it to say that these types of events are usually followed by positive market performance. And on this slide, we have a history of market corrections. So again, more perspective building here. So, we've talked about this, the typical duration and impact of market corrections, and not to say that this is the end all be all of corrections, but, we have seen a 10% decline from our peak in the major indices here to date, again, from the peak. So if you look at the S&P 500 index, just take that, all the data on the left-hand side. So, the 5% or more decline, which is a pullback, I guess, in kind of layman's terms, you get those about 3 times a year. Now, during that long expansion that we had, we rarely got that. We really even didn't get that last year. And the average length of that pullback is roughly about 40 days. And we had one in October of last year. Now, a 10% decline, that's really more of a correction. And you typically see those about every 16 months. You see the duration there, about 130 days, and that's just really kind of you get a pullback, and you get a little choppiness in the market, and then goes back up. Last time we saw that was obviously March of 2020 when we had the shutdown, etc. The 15% and 20%, then you're talking about like bear markets. We had a really short one in March of 2020, as you recall. You typically don't get those, but every few years, and they do last a little while. But again, they eventually age out, and then you have the resumption of another bull market, and so this just gives you a little bit of perspective on that. This is a very busy chart, but really what I want to focus in on is with all of the news items, all of the events that have come up that have created volatility in our markets. If you go back to 2007, which is where this chart takes us, and you say, well, you started off with $10,000 in 2007, I mean, you'd be up to 43,303 by the end of last year. And so I think it's important to realize, again, to the notion that investing is as much a marathon as it is a sprint, that you have these bouts of volatility, and you can see these as that chart is kind of climbing up the mountain, so to speak, that where you get these large corrections, but then they bottom out. You kind of clear out the mechanism, so to speak. You kind of clear out investor sentiments. You finally get short sellers that are interested in covering. Then you get speculators that are exiting their positions, and more value oriented buyers or people with liquidity sitting on the sidelines get into the market, and then that drives an upward market expansion. You can see after every downturn that has happened. So I just offer this as kind of this this food for thought, that while we do have these bouts of at the time it feels like pretty emotional type volatility, that it always corrects itself out. Here we have bull and bear markets. Again, more perspective building, right? So you can see the average bull market here lasts about 4.5 years. And they usually drive a cumulative return. This is not an annualized return, but it's like a total return for that particular bull market of 156%. And so the average bear market lasts not even a year, right? And then with an average cumulative loss of about 30% from basically to the trough. And you can see where these points in time have occurred. So obviously the most recent one was in 2020. That lasted barely a month. Market was down about 34%. But in the ensuing 1.8 years of the new bull market, we've had a cumulative gain of 113%. And so then again, you go back to 2008, the drawdown was around 50% overall. And in fact, we had almost a head fake. We literally had like two bear markets within that recession. But if you assume that the overall drawdown at its max point was like 50%, then you had 400% in the next bull market. So again, you tend to spend a lot less time in bear markets than you do bull markets. And it's the veracity of those bull markets which gives us our long-term return. And really from an investment manager standpoint, what you're trying to do is you're trying to minimize what we call the downside capture, which is how much do we participate in those downturns in a bear market. What we're trying to do is minimize that so that we can enjoy as much of the upside as possible. And that helps us reduce overall volatility in our portfolio, and from a risk-adjusted basis helps us generate better overall returns and probabilities for our clients in terms of their ability to meet their financial plan. I thought I'd show this too from First Trust, and it shows you intra-year decline. So it's helpful to know, and in fact, this may be actually one of the more powerful charts in this pack today, because it shows you, and we saw, a few slides ago, that the markets can have really strong down days, but then when you look ahead, 1, 3, 5, and 10 years, you have really, generally much stronger performance. And here it looks like at each calendar year at the trough in the orange area, kind of like where the market dropped the most in that particular year. Just take 2020 for example. Like we know that we had a 34% downturn for that month that we were in that bear market. But the overall return for 2020 was up 16%. And then we actually had, at one point, a 5% downturn in the market in 2021. But the market was up about 27% that year. And so you can see here that even when you have years in which you have a really strong pullback, that oftentimes you wind up at the end of the year with a positive returns. In some cases, a really positive return. So I think this is all perspective building here. So, when we worry about the impact of a 10, 15 to 20% intra-year drawdown, just keep in mind that oftentimes that reverses and you get a really strong overall annual performance number. I put this rather crude spreadsheet together myself, just collecting data and putting it into a spreadsheet because I was really curious. If you look at 5, 10, and 15 years, and there's a kind of a better visual chart that follows this, but I think it's fair to say that, and this is just overall rolling returns for the S&P 500, that over 15 years or even 10 years that you rarely get a negative return over a rolling 10-year period. Now it happened in 2008, 2009 because you were also including what happened in 2003 and 2002 and 2001, and so the weight of those two rather strong market downturns was enough to turn that 10-year rolling number negative. But if you didn't have that, then you can see here that the 10-year rolling returns have actually been quite positive. Here's maybe a better graphical depiction of that. So this shows you 10-year rolling averages going back to 1937, and the average of those 10-year rolling return periods has been about 10.3%, which not too surprisingly is very close to the long-term average return annually in the S&P 500. So you think that the longer your rolling term is, the more it's going to look like the long-term average anyway, and that's exactly the case here. But having said that, you can see that that does ebb and flow, and like I said in the last slide, 2008, 2009, you had a rolling 10-year period primarily because we had such a strong and prolonged downturn at the beginning of the century when the tech bubble burst, and then you also had the financial crisis in 2008, which again captured that within that 10-year window. But since then, we see those rolling returns really positive, and I think from a financial planning standpoint, this has a lot of power to it. So I got this from Strategis, and this is taking other events and other points in time, and you've seen iterations of this chart already in this chart pack, but I think it's just more food for fodder here that when you get a really unusual day, like in the middle here, you've got the 1987 stock market crash. And if you go 20 days out, 65, 125 days, it is possible to have a negative return at that point. That was certainly the case in 2008. But generally speaking, and more often than not, about at least 2/3 to 70% of the time, over a relatively interim period, you're going to have positive performance in the market. So I got this from another slide deck, doing some research on all this. So this is the percentage of positive and negative rolling returns, right? So these are annualized returns from 1926 through the end of March of 2020. So it's kind of incorporating that really weak month of March. So you see a 1-year rolling period, you've got you're going to be positive about 75% of the time. So 3/4 of the time, you're going to be positive, and your average rolling return for a 1-year period is 12.26. If you look at 3 and 5 and 10, you see those percentages of positive return observation goes up. So again, there's a lot of power in long-term planning and taking the emotion out of it. If you're diligent with your strategy, you hold to it, you don't sell in a panic time, and you kind of stick to your guns, even though it may feel odd at the time because of the volatility in the market, that it does pay dividends in the sense that you get a higher probability of positive returns. And so if you look at the rolling 10-year return, again 10.3, which is very close to the long-term average here, 95% of the time you're going to have a positive observation. And from a statistician's point of view, 95% is actually pretty strong. So this is another view of really the same types of data. So your analysis period is slightly different. So instead of 1926, you got 1936, but directionally all these numbers are very similar. I just put this in here because you basically have two slides back to back that are telling you exactly the same thing, that the probability of positive returns any one given day is just over half, right? If your holding period is a day, then you'll be positive a little bit more than half the time. Now, if you're looking at a month, that goes up to 63%, and if you're willing to hold for a year, again, you're 3/4 of the time you are going to have a positive return, and that just goes up the longer your investment horizon is. Well, I sure hope that this has been helpful. When we hit these bouts of volatility, I think it's always really good to kind of level set ourselves and really try to take the emotion out of it and bring some more education out that shows you the virtue and the power of long-term investing. Now, it's not going to take away, some of the pain of looking at positions going down really here over the near term, but I think one of the real virtues of active management is the ability for BKA to be looking at the investments, looking at allocations, looking at are the investments that we are using, are they doing the job that we want them to do? And oftentimes we take advantage of these times to potentially make changes in the portfolio that can be beneficial when the volatility evens out. So I'd say that we're always looking at these opportunities. And if you have any questions, we want you to reach out. Here's the contact information for me personally, but feel free to reach out to anybody in the firm. Our phone number for the firm is 512-522-4838. Again, I hope you've enjoyed this perspective build, and we look forward to answering any questions you have, and stay the course, and we hope to visit with you very soon. Take care. Bye-bye.